Your financial advisor has been lying to you. Perhaps inadvertently. Maybe they didn't even realize they were doing it. But now, hidden in your income record is a Social Security calculation that can swing your lifetime benefits 40 times. $50, sometimes more than $100,000. In finance, few people ask you to sit down with you. In the next few minutes, I'll put it on the table. We will detail the exact formula used by the Social Security Bureau. That number is $1,286, $7,749, and it determines how much you spend the rest of your life on a check. You will understand why 60 is more important than retirement. I'll show you a 12-month renovation rule, hidden in government forms that few consultants mention, because frankly, there is no commission for telling you about it. If you are between 50 and 70, the video will cost you many times. Get comfortable, have a coffee. Let's do the math. The teacher skipped. Here is what bothers me. Walk into the office of any financial advisor in the United States. Ask them when you should apply for Social Security. You'll hear one of two answers. Or when you are 70, you get 24% more. Or start at 62 before the system crashes. That is the whole conversation. Two topics. Both are technically correct. Neither is useful without a solid mathematical foundation. Social Security is not a savings account or pension. It is a formula. As early as 1977, a very specific and strange formula was written into federal law. This formula has bending points, exponential factors, 35-year average window, rules most people have never heard of. Once you understand them, your view of the past decade's work has completely changed. None of this is hidden, by the way. It is all done in simple English on SS.gov. The trustees publish it every year, published annually by the Office of the Chief Actuary. The Congressional Research Service has a paper on it called If 11,747. If you want to review it tonight, the message is there. No one was watching. Most consultants don't look either. The reason is simple. Social Security does not pay them asset management fees. They don't get any income from counting your benefits. They make money by managing your personal account. That means Social Security gets 5 minutes of conversation when you walk out the door and leave real gold and silver on the table. Today, there are no consultants, no promotions, no after-sales service. It was just calculation. Let's start with the rules that quietly do the most damage to the retirement income of ordinary people. Social Security focuses on your top 35 years of income. Not your last 35. Not your last 35. But your top 35 adjusted for wage inflation. These years add up, divided by 420 months. That is 35 years times 12. Then work out a number called your love of beauty. Your average index monthly income. Sounds simple. That is the depressing part. If you don't have a 35-year income record, SSA isn't just what you have on average. They use zero, fat zero. These zeros are averaged as if they were real work years. Imagine that number. Let's say you've been working for 34 years and you are making a decent salary. You retire at 62 and feel like you've invested your time. The NSA adds up your best 30 years, rounded to 35, zero within 5 years. Divide the whole thing by 420 months. Your average is down about 14%, forever, for the rest of your life. Every check until the day you die is smaller, because of math. Now, flip the scene. Another year. Bawa Miyuan. $80,000 is not simply nailed to your records. It replaces one of the zeros. That means the $80,000 figure is now within the average of zero. Monthly benefits also grew much more than expected. This is the most actionable message in the video. If your income is less than 35 years, for every additional year of work, zero will be replaced. That is why a year in your 50s and 60s is sometimes more valuable than 2 or 3 years in your 30s. This is a key factor that most consultants will never mention. If you've earned more than 35 years, New Year's work will also help. but only if they are above the lowest year on record. Because once you are over 35, the SSA stopped adding and started swapping. Every year you invest, you knock down a low-income year. Or not at all. Imagine you are 62-38, working in a book. The worst 3 years on record were the summer minimum wage since 1984. Those summers were your competitive years. Exceeding these numbers will give you a raise, and failing to meet them will not give you additional benefits. Investopedia published an article titled, "Your $0 annual fee may be shrinking your Social Security." Yahoo Finance basically wrote the same article. Hartford Fund issued a customer dialogue guide on the same topic. Information is everywhere. It was just drowned out by headlines, claiming the age and duration of trust. So, Lesson 1. Grab your Social Security statement tonight. Log into your My Social Security account at SS.gov. Count your age. If you are not 35, you are fine. Every other year, you can squeeze in before claiming you're worth it. Once you have a goal, your 35-year average. The next step is something few outside the actuary's office really understand. Bending point formula. Imagine 3 buckets. The first is at the bottom of your average income. The second is the middle part. And the third holds anything above that. Social Security gives you different replacement rates. For people who turn 62 in 2026, the numbers come directly from a page on SS.gov titled Bending Points in Welfare Formulas. The barrel broke. The first $1,286 of your average monthly income is reimbursed at 90 cents a dollar, from an average of $1,286 to $7,749 a month. Social Security pays 32 cents a dollar. Any expenses above $7,749 are eligible for reimbursement of $1.15. Stop and see what just happened. 90%, then 32%, then 15%. The first money you make in your life. You worked at a pizza place when you were 17. When you get your first real job at 22, the repayment rate is 6 times what it was at the peak of your career. That is why Social Security is ranked as the most progressive part of America's social safety net. A low-wage worker can see Social Security replace 75 to 90% of pre-retirement income. The highest earners who have reached the wage ceiling every year of their careers end up with a replacement rate of close to 25% or 27%. The Congressional Research Service listed the full numbers in the F11747 document. In fact, that is why it matters to you. If you're a high earner, stare at your statement and wonder if you'll be working for another 2 years. The bending point formula is whispering to you. Amy has passed the second inflection point of $7,749. For every extra dollar you earn, you get a lifetime benefit of 15 cents. 15 cents. That is it. A middle-income man and a poodle sat between the first and second laps. But for every dollar you earn, you get a 32-cent lifetime benefit. The rate of return has more than doubled. Down at the bottom of the curve, you can buy 90 cents for every dollar. That is why late in their careers so-called sideline income outstrips its weight for some, while for others it is barely registered. It is past the top corner. The amount of Uber money you made at 64 has barely changed. A housewife who has worked only 20 years is part-time, but the hands of the watch moved many times. Few do such calculations. No advisor will tell you which bucket you're sitting in. They gave up, and yes, working longer hours is a good thing. Overtime is sometimes a good thing. Working longer hours is sometimes almost worthless. Bending points determine which one applies to you. A brief background note. In 2025, the previous year, the group was 62 years old. The turning points were $1,226 and $7,391, respectively. These figures rise slightly each year because they are related to wage inflation. Note, this section. At 62, your turning point is locked in, not the year you claimed. Even if you are 70, your benefits are still based on 62 inflection points of your age. Just turn up the Coke. If you are 60 now, take a closer look at the bends announced next year. These are your inflection points for life. Now, let's talk about calculations that your advisor really didn't mention. Wage indexing. When Social Security averages your best 35 years, the agency does not calculate your income at face value because you didn't make as much money in 1988 as you do today. Obviously, multiply your annual income by a so-called exponential factor to bring it to current wage levels. That is why when the NSA calculated your benefits, the old 1985 payroll showed income of $18,000, which could be $66,000 or more in today's dollars. That is the part nobody talks about. The index stopped rising at age 60. I'll repeat it because that is one sentence from the whole video I want you to remember. The index stopped rising at age 60. Before you turn 60, your annual income swells to your current salary. Incomes aged 60 and older are measured at face value, excluding inflation. No matter how much money you make, that is the average. In a normal wage growth environment, this means that in your benefit calculations, income in your 50s is quietly more valuable than income in your 60s. Because income in the 1950s is being priced, not in the 1960s. I don't want to exaggerate the effect. SSA still applies COLAs to final benefits, so the income after 60 is not worthless. But structurally, the marginal benefit of hard work at age 58 is greater than that at age 65. Everything else is equal. It is facts about formulas, not opinions. It also explains that if you look at the NSA statement and realize that even if you continue to work, the expected returns will hardly change, you may notice a strange thing. It comes down to some combination of three things. They are all compounds. You are 35. You've passed the second inflection point, and your new income is not indexed. You're working hard, paying every paycheck for FICA. The welfare needle did not waver. It is not a glitch, it is a recipe. Once you understand, you can stop being confused by your statements and start making the decision to actually change the numbers. The root of all this, by the way, is that Livestream has a page in SSA.gov of await, awifactors, HTML called the yield index factor. It has been sitting there for years. It was very dry. Most quit after about a while. I don't blame them. Let me tell you a rule. If you ask this question at a financial planning seminar, that clearly rattled advisors. The rule is called withdrawal, Form SS-521. Here is what it does. Once you apply for Social Security, if for any reason you regret the decision, you have 12 months to file Form 521, withdraw the application, and reset the entire decision. Every dollar you receive is repaid. Any withheld Medicare premiums are repaid. Any withholding taxes will be repaid. You're basically an advocate for the United Nations. Once you do, in the Social Security Bureau's view, you never claimed it. The application date is the 5th of June, the 7th of June or 70. That means your benefits will be recalculated, just as you've been waiting. If the full retirement age is exceeded, the full deferred retirement credit line is 8% year. This is a page on SS.gov called Cancel Benefit Request. This is real, documented. It is one of the most powerful alternatives the federal government offers in any program. Few people use it. There are two reasons for this silence. First, you have to repay everything you get. If you've already spent your money on rooftops, cars, or hospital bills, but that is not the case. Second, you can only do it once in your life. One time, reset. Use with care. That is where it has become strategic. Imagine you applied for layoffs at age 62. 6 months later, you found a new job, a good one. Now there are claims that this is the wrong move. You don't need income anymore. You are more likely to receive higher deferred benefits. In this case, most people just shrug and always accept smaller checks. Because they don't know Form 521. Conservatively, they leave $50,000 to $100,000 for the rest of their lives. Missed the 12-month window? You don't have to have no choice, because there is a second little-known measure called voluntary suspension. Once you reach full retirement age, you can ask SSA to suspend your benefit payments and start receiving extended retirement credit at an annual interest rate of 8%. Until he was 70. Imagine these two steps. The claim occurred at age 62. You are 67 now, and realize you wish you weren't T. You can stop at that moment. Let credit accumulate for 3 years. Starting a business at 70 makes more money than the day you close. It is not a hack, it is not a bug. This is actually a function listed on a page called Suspend Retirement Benefit Payments on SS. On the menu, 2 authentic, legal, and documented government agencies. I bet the last advisor you spoke to didn't ask any questions. It is time to discuss this rule, which may scare away people in their 60s more than any other rule in the system. Profit test. Here is what you hear. If you apply for Social Security in advance and continue to work, the government takes back your benefits. The threshold for 2026 is $24,480. In addition, $1 will be deducted for every 2 people above the income line who apply for benefits under retirement age. The year you actually reach full retirement age, the threshold jumped to $65,160, and the withholding tax rate softened to $1 per triple limit. When you really reach retirement age, the earnings test disappeared altogether. Make as much as you want. The interpretation of this standard is accurate. It is also incomplete, spending thousands of dollars in unnecessary anxiety, because it is gone. Those benefits have not gone away. They are not taxes or punitive penalties. The United States Department of Agriculture tracks their detained benefits every month. Once you reach full retirement age, the agency recalculates your monthly benefits upward to repay the amount you withhold for the rest of your life. An online article called it Implicit Punishment of Active Retirees by Social Security. The overall view of the article falls on the misleading view of the criminal law framework, because the money is back. It is like a slightly larger monthly check after the FRA, not the original payment under the FRA. In practice, the earnings test. Its actions are more like forced delays than actual losses. Beyond retirement age, living a normal life, you basically take back what you have. Longevity, you can move on, because the recalculation will lock in a larger monthly base in the coming years. Does that mean the earnings test doesn't matter? No, because it still causes short-term cash flow pain. If you don't want benefits to be withheld and you've already budgeted for them, it will still produce very bad results. It will certainly interact with taxes in chaotic ways. A version of pure financial loss circulating during family Thanksgiving. But that is basically wrong. It is important because I see people really saying no. High-paying jobs in their early 60s, worried that income tests would evaporate their Social Security checks. The truth is, in most cases, that is a better financial outcome. Wages came in. 0 years in the record were replaced. Any payments withheld by the NS, they will be reimbursed as higher monthly benefits. It is not advice, it is math. Run your numbers. Run them with the right recipe. Count again. I bet $100 that your advisor never showed you this on a piece of paper. Tax your benefits. Most people hear that Social Security is taxable and assume that it works at a fixed percentage of ordinary income. In fact, this is a 2-tier system based on so-called temporary income. Those thresholds were written into law in 1984 and 1993. Here is what should make you angry. These thresholds have never been adjusted for inflation, not once, for more than 40 years. The numbers came directly from a report by F 11397, a Congressional research service. As a single filer with temporary income of less than $25,000, your benefits are not taxed. More than $25,000, up to 50% of benefits will be taxed. More than $34,000, up to 8 to 5% will be taxed. Married couples can also apply together for $32,000 and $44,000, respectively. Consider what $25,000 meant in 1984. The middle class is well paid and teachers are well paid. Today, $25,000 is, frankly, almost zero. A modest pension and an ordinary Social Security check can easily cross that threshold. Because after Coca-Cola, as of December 2024, the average monthly Social Security retirement benefit was about $1,975. That adds up to about $23,700 a year. This alone has almost reached the first threshold. In fact, welfare taxes, initial crackdown on high-income retirees, at the level of most beneficiaries, growing every year. Inflation fluctuates, and the threshold remains unchanged. This is what people call an invisible tax increase. Congress doesn't have to vote. No political pressure. It happens automatically every year. Do nothing. This has been happening for more than 40 years. Charles Schwab published a very good article on this, before and after managing Social Security taxes. They emphasize that a small increase in temporary income can greatly change your tax results. A switch by Ross at the wrong time generated thousands of dollars in revenue. Windfall capital gains. You don't have a planned minimum shipping requirement. Any of these plans can be converted from 0% of taxable benefits to 8 to 5%. There were few warnings. That is why the order in which you withdraw your retirement account is so important. Why the Ross transition before starting Social Security in your 60s is one of the highest return planning measures you can use. Now you trade a tax bill for much less temporary income. Protect your interests from the tax cliff. Few people look at these calculations in simple terms. Ross's transformation is presented separately. Decisions on Social Security needs shall be submitted separately, and the interaction between the two. All the real money lived there and was skipped before the close. I wanted to talk to the elephants in the room because I know it is in your heart. If the trust goes bankrupt in 2033, why should I calculate my Social Security? Here are honest answers. Trustee Report 2025, issued on the 18th of June, 2025. The Pension Survivors Insurance Trust will be exhausted in 2033. The same forecast as last year. At that time, the system will still pay about 7% of the plan benefits from continuing payroll tax income. In addition, due to a lack of legislation, the combined OASD fund is expected to run out in 2034, with about 19% of welfare cuts. The data came from news releases issued by the National Security Agency and analysis by the Federal Budget Committee, which monitors the data. A few things will clear your head. Exhaustion doesn't mean it is gone. Exhaustion means that the buffer fund is exhausted, while the program itself has been imposing payroll taxes on American workers. These payroll taxes maintain economic benefits. The cliff fell about 20%, not zero. If you want to see me, roll your eyes at me. But historically, every time Social Security goes to the edge, Congress did something at the last minute. They worked with the Greenspan Commission as early as 1983, raise the retirement age, increase welfare taxes, and partially repair. Will Congress do the same? Maybe. Will the repair be painful? Maybe. Actuaries predict that people in their 60s will wake up with zero benefits in 2034. In fact, the steps we cover today do not depend on the adequacy of the trust. They depend on the recipe. Bend point index. 35-year rule. Renovations, closings, taxes. All of these mechanisms depend on your return relative to the largest possible scale. Even with a sharp 23% cut in interest rates, those who plan ahead are still ahead of those who don't, the same proportion. Here is another notable piece of news. The Social Security Rights and Interest Law was signed into law on the 5th of January, 2025. Eliminate windfall, elimination clauses, and government pension offsets. If any part of your career involves uninsured work, teachers, firefighters, police, federal workers, under the old CSRs, your benefits are now being recalculated upward. SA began adjusting payments on the 25th of February, 2025. If it is you, and you haven't checked your account in a while, check it. It is time to bring this in. Here is what I want you to actually do this week, not next month, this week. First, log into your My Social Security account at SS.gov. No, create one. Take out your income record. Count your years. If your savings are less than $35, write down the average number of zeros you need to absorb. That is your gap. Second, look at your expected returns in 3 age groups. 62, fully retired. 70. Please pay attention to the price difference. This spread is the leverage you actually control, because every part of the video is about deliberately closing or expanding distribution. Third, check that your income records are accurate. Errors occur. Employers misstate. Married, person name, change, mismatch. SSA has limited window to modify old earnings. That means the longer you wait, the harder it will be to fix them. Fourth, if you are between 60 and 62, write down the inflection point when you were 62. These are turning points in your life. Glue them to the refrigerator if necessary, because they are the two most important numbers when you retire. Fifth, if you already claim and regret it, less than 12 months later, take out form SS-521 and have a serious conversation with someone who knows what you are doing. The law gives you the right to redo, so use it carefully. 6. Don't substitute them for personalized advice. I'm not your CPA or your financial advisor. I don't know you. I'm an actuary reader, so you don't have to. The numbers in the video are public. These formulas are public. The tactics are documented on government websites. You don't need anyone's permission to learn these things. If this video saves you money, even if it is just a message you didn't have before, press my favorite button. It really helps push such content to more people who need it. If you want me to use an actual break-even scenario to mathematically break down the claim ages of 62, 67, and 70 in real dollars, write a note in the comment. I will. There are many more. The calculations your advisors never mentioned are no secret. It is a formula, a boring, public, 50-year-old formula, but the benefits are not. The advantage is focus. See you next time.